Thanks for downloading this episode of the Resilient Advisor Podcast. My name is Jay Coulter, and joining me for this episode is Larry Miles of AdvicePeriod. And we are going to discuss how advisors can add enterprise value to their business. Now, Larry is a principal at AdvicePeriod, a firm whose mission is to reinvent wealth management. He has over 2 decades of industry experience, and I know you will find value in his thoughts around building enterprise value in your business. Larry, thanks for coming on the podcast.
Jay, thank you very much for having me.
Well, let's get right to it. What can advisors do to build enterprise value in their business?
The first thing advisors can do to build enterprise value in their business is acknowledging that there's a problem, that there's a missed opportunity, and that building enterprise value is important whether you plan to sell your business in the short term or you plan to run it for a long time. The habits that will help you build enterprise value will also help you build a great business. And the 3 things that I think are most important are people, proprietary, and process. It's that simple.
Let's go a little bit deeper on those.
So with people, by great people, I mean not just great employees, great teammates, but also great clients. You can't have a great company if you don't have great clients. You have to have clients that need your services, clients that appreciate the work that you do, and clients that are willing to pay a fair fee for the value that you add. And they pay on time. You have to have great clients or you can't have a great business.
Yeah. And so this principle is going to apply whether you're an independent, an RIA, or even still inside a wirehouse, correct?
That's right. Every advisor wants to have great clients, and when you think about building enterprise value, you have to have great clients. There's no way of getting around it. And similarly, you have to have great teammates. There's the most valuable businesses need to be about more than just one person. You want to avoid that key person risk that really reduces value. An advisor's business is automatically worth more and it's more valuable if you're part of a larger enterprise. And I think that's a challenge that a lot of very successful advisors have, is building a business that's bigger than just the 1 or 2 main folks, the founders, the rainmakers. But that's a huge opportunity for all advisors.
You know, Larry, in my experience, that even gets down to what you name the business. So we've worked with folks that have named the enterprise after themselves, or a team inside of a wirehouse that has named their team the Bob Smith Group, changing that to a name that has more of a marketable factor to it instead of the key person's name, we find has helped. What has been your experience?
I completely agree with you. We think if you're building enterprise value, if you want to make the business bigger than just one person or like you said, a group of people, name it something that really speaks to the vision of what you want to build. Because it's both about building a business that's bigger than just 1 or 2 people, but it also speaks to the culture of the business that you're building. Culture is massively important to creating enterprise value because it helps you attract and retain the best people. And if you put your name on the door, you're sending a message. It's not wrong. I know lots of great advisors that have named the business after themselves, but it definitely sends a message that it might be more about you than about the team, than about the vision. And I think the best businesses want to attract those missionaries that are inspired by your purpose and your vision and your mission. And that can be easier to convey if you don't name the business after yourself.
Sure. You know, there's a lot of content out there around building culture inside of a firm. Do you have any best practices from your experience working with advisors?
I'd say much like deciding to purposely build an enterprise that has value, with culture, it's very similar. Every company, whether it's 1 person or 1,000 people, every company has a culture. And you either get the culture that you get or you purposely build it. And I would strongly recommend that you very purposely and with much intent build the culture that you want that's going to attract like-minded clients who value what you do So that's how you have culture translate into great clients. But it's also going to attract the missionaries who are going to work for you because they are inspired by what you're trying to do, not just mercenaries that are working for a paycheck. So build your culture very purposely, identify what's most important to you and your business, and then highlight those things. Talk about them. Because ultimately, culture is one of the things that is intrinsically connected and a part of your business that's very hard to replicate. I mean, in a word, it's proprietary. And if you build that amazing culture that's attracting clients, that's attracting great team members, that's going to build enterprise value, because the only way that someone else will be able to get it is by investing in your business, buying your business, or joining your company. So culture is massively important.
So as you look around our industry, which firms can you point to that have already done a good job of building that culture?
Well, I think when you look at the folks that other people want to go work for, those are the ones that, in my mind, have great cultures. Those that have a line around the door, around the corner, waiting to go work for someone. And you think of a lot of the brands, whether it's in the independent space, it's probably more regional and by RIAs. When you think of more national firms, you think of the brands that attract interest from clients and advisors alike. That's that magnetism that a culture can provide. And sometimes that culture is personified with an individual, like a Rick Edelman or a Ron Carson. But those are two folks that have obviously used their name on their business and amazing businesses they've built. So those to me are the hallmarks. If you have a line around the corner of both employees and clients wanting to come work with you, that's a sign that you've built an amazing culture.
Yeah, I tell you, I also, in addition to the folks you mentioned, think of United Capital and Mariner Wealth. And the correlation between all four names that we've thrown out is they're all growing exponentially. And you have to think
Yes.
Culture has a lot to do with that.
No question. Yeah, United is a great example. Mariner's a great example. Dynasty is a great example. I mean, these are amazing businesses that have been built by great teams of folks that has the name recognition, and it's someone that you're going to call if you're looking for their services.
All right, so you mentioned that there are three components to building enterprise value: people, proprietary, and process. What do you mean by proprietary?
By proprietary, I mean something that is unique to your business that a buyer or an investor can only get from you. And a couple things that occur to me. One would be technology. I think that's oftentimes what people think of when they think of something proprietary. And here too, advisors have to believe, and I think this is crucial to success, advisors have to believe that technology is not a nice to have, that it's a must have.
Well said.
In my opinion, technology is the number one most disruptive force in our industry, and it's the number one biggest opportunity. There will be winners and losers in the advisory space based on how those advisors implement and embrace technology. Things like artificial intelligence, machine learning. Our business is very rules-based, meaning that as advisors, we work with our clients and we ask questions, and then based on the responses we get, we ask additional questions. All of this can be systematized and will be, and it's going to happen much more quickly than anyone anticipates. And so as advisors, if you embrace that change and you embrace the opportunities that change creates, you'll become massively successful. If you're able to integrate these third-party technologies with proprietary glue, if you will, that makes your business that much more valuable. Embrace technology and build that glue that connects third-party technology. Your business's enterprise value will increase significantly.
So the tech stack is obviously important. What I hear you saying is the integration of that is an opportunity to add enterprise value. And could you give me a couple of examples of what that would look like to the advisor?
Absolutely. So yes, I think that technology is moving so quickly today that you really can't build You can't build it all from scratch if you're an advisor. It's just there are too many dollars out there trying to do it. So instead, what we think is you take the bricks of the third-party technology, like the CRM system, like your performance reporting system, your rebalancing system. You buy the best third-party software you can get, and then you integrate that technology by configuring APIs and building other connections so that it's seamless, so that data gets input once, not 5 times across all your different systems. Getting that to work seamlessly from meeting a prospective client all the way through to converting that prospect to be a client, and then on the ongoing management of that relationship. If you're able to seamlessly integrate that, that's the holy grail of technology, and it's coming very rapidly.
Yeah, I would also think having the resources to adapt as new technologies roll out would provide some type of, I don't know if enterprise value is the right term, but God, the speed of change in technology is overwhelming to advisors.
It really is. And what comes up for me is, much like we were saying that to build enterprise value, it can't be just about one person. I would suggest that the best firms, or the winners in this technology arms race, will be those firms who embed technology in their culture and make it everyone's responsibility to find, implement, and adapt the latest technology. Don't leave it up to just one person in the IT department to find the next great piece of technology. Make it something that everyone can get involved in, and you're going to increase your odds of success.
Excellent. So also, as it relates to proprietary being a key driver of enterprise value, the advisor's brand has to fit in that bucket. Is that fair?
No, I think so. And you mentioned some firms. We mentioned some firms that have amazing brands, and those don't happen by accident. They happen very purposefully. Just like you have to purposely define your culture and your mission. If you want to stand out, you need to stand for something. And then you need to tell the world about it. Write about it, speak about it, go on podcasts to talk about it. You have to stand for something if you want to stand out. And if you build that brand, it's something that's not easily replicated. Those firms that we mentioned, the United Capitals of the world, the Dynasties of the world, there are only a handful of them because it's not easy. And they've done a masterful job of standing for something and then telling the world about it. And every advisor can do the same thing.
So that's one of the key components of our consulting engagements at Watley & Company, because most folks, all the folks that we engage with at the beginning don't have a brand, and B, putting those systems in place that help build that brand over time is just adds so much personal value, and then of course enterprise value over time. What we struggle with is getting advisors to understand that it is a long game you're playing with that brand. Is there a way you communicate that or help speed up that process?
I would agree with you that there's no shortcut. It does take time, but it's that old joke about how do you eat an elephant, one bite at a time.
Yeah, right.
And that first piece of branding, once you identify what your mission is, that first one is the hardest. The second one's a little bit easier, the third, and you make it like anything else. You make it a habit and you make it a routine. You don't make it something else that you do. You make it core to what you do. And I think that's really important for all aspects of what we're talking about, whether it's culture, technology, brand building. Don't do it off the corner of your desk. If it's important to you, spend time on it. And over time, you can do anything in 6 months. You can do even more in a year or 2 years, so that you wake up this time next year and you've invested significantly in your brand.
All right. So I love your simple approach to adding enterprise value: people, proprietary, and process. Let's go a little deeper on process.
So at the core of I think a lot of these challenges, and you probably see this with your consulting engagements, at the crux of this valuation discussion is the fact that there are many great advisors who are not great business people. And there's nothing wrong with that. These great advisors oftentimes don't have the business discipline, that allows them to build a repeatable process that would allow them to build technology or to build a brand. And so they need to surround themselves with a team that can do that for them. And whether that's something that's done in-house with building out an executive or a leadership team, whether it's they surround themselves with great advisors, consultants, external resources that can help them. These firms that we've talked about today didn't get there by themselves. Even if there's one person's name on the door, they had an amazing team behind the scenes helping them build that. And so the best advisors surround themselves with the best people. And I think that's massively important.
Yeah, there's a quote from the guy who created Dilbert, Scott Adams, that I love to bring up at the beginning of consulting engagements. And he says, losers have goals. Winners have systems. And it's so blunt and to the point. You have to have those systems and processes to get anything done. And I usually throw that out right after we're going through a discovery process in a consulting engagement when I ask where they want to be in 5 years. And the answer is always one of two things. I want to be $1 million producer or I want to double my business. With no credence to exactly how they're going to get there or the work they're going to put in or the processes that they'll have in place.
That's right. That's right. Hope is not a plan. And a lot of this planning just it's not the area of genius for many great advisors because so many of the best advisors get into our industry because they love helping people. They love working with clients. They love finding new clients and figuring out the puzzles of how best to help these families and building systems around how do you recruit people and how do you turn those great recruits into a championship team. Massively important in our industry, but not something that a lot of firms think about purposely. And I think there's a huge opportunity there. And likewise throughout all the systems, it's not just technology and people, but it's how we charge. I see too many financial advisors charging the wrong way and for the wrong services. They're charging by the hour or they're selling financial plans one at a time. But that doesn't build enterprise value. To build enterprise value, you want to have recurring revenue. And I would suggest that not just recurring revenue based on asset-based pricing, but recurring revenue that allows you to charge a fee for all the value that you're adding. Because oftentimes, financial advisors, clients, their biggest assets aren't liquid investments. It could be business, private real estate. If you can figure out a way to charge a flat fee for all of that advice, you're going to increase your revenue opportunities, and ultimately drive enterprise value.
Well, that's interesting, Larry. Let's use that as an opportunity to pivot into what your company does, and maybe you could give a concrete example of what you're talking about with regards to how to charge differently for enterprise value.
So at AdvicePeriod, we believe in charging a fair fee for the value that we add. The more value we can add, the more we'll charge. The less there is to do, the less we'll charge. It's not tied to assets under management. That's an irrelevant statistic for us. We look at how much value there is to add. And so what that allows us to do, a specific example, a family that has a very significant privately held business, let's say it's worth 10, 50, $100 million. That's the largest asset on their balance sheet. If I was charging an asset-based fee, there'd be no way for me to get paid on that. And yet, as an advisor, advising them on that business and how to structure it for future generations, whether they're going to keep it or they're going to sell it, if we can help them arrange their estate so that they disinherit the federal government and save on the estate tax, that's going to pay for our fee in perpetuity and add more value than we ever possibly could by helping them with their investments. And yet that's an opportunity that a lot of advisors miss because they're only charging or they're only able to charge an asset-based fee. And so we found that by charging a flat fixed fee, a retainer fee, if you will, we bill quarterly in advance. It increases by 3% every year for inflation. That elastic billing mechanism really allows us to charge, again, a fair fee, but we're able to add more value and charge for it. And ultimately, we think that's driving our enterprise value because we're increasing revenue and our revenue opportunities.
So let's walk through an example. I'll give you a client situation, and maybe you could give us a general guideline on how your firm would price this piece of business out. So say I have a small manufacturing business, estimated value $10 million. I have $1 million in IRAs spread out at a bunch of different banks, and I'm covered in life insurance.
Okay.
How do you price that client?
So what we've done, and we were very transparent with clients, we've identified each of the different areas that we think we can add value. Asset allocation and manager selection, in our opinion, in the scheme of the value proposition, is not worth very much. You can Google asset allocation and find a pretty good one. You can go to Vanguard directly. So we don't charge very much for that because on average, it's just not that valuable. That's been commoditized in our opinion. And so we tell clients that there's some fee for it, but it's pretty small. The real value for that situation is going to be, how do we structure a financial plan so that that family can continue to build the business if that's their desire. If their desire is to sell the business, how do we help them maximize their after-sale, after-tax proceeds? And so we've built a calculator which we share with clients, and we've written a white paper about how it works that says, listen, and we plug in the $10 million business, we plug in the $1 million in the IRA, we type in how many family members there are, and that helps us estimate how much value we think we can add and what we think a fair fee is. It's like a Monte Carlo. It's not exactly right, but it gets us in the right neighborhood and allows us to have the discussion with the client about what the fee should be. In round numbers, a fee in that situation, if we're helping them with the estate planning, would be about $100,000.
Okay. And are you basing that based on the business or the business and the IRAs?
It's both. We're looking at the net worth of a family, and which includes liquid as well as illiquid assets, and we're thinking about how much value there is to add. If that business was worth $50 million or $100 million, the fee would go up because there's more value that we can provide by helping get that enterprise value out of that family's estate so that it can be passed on to future generations free of estate tax.
Okay. And how could listeners get a copy of the white paper you just mentioned that walks through this?
Yeah, it's on our website, adviceperiod.com, as is a number of white papers that outline kind of our belief system. And likewise, I'd be happy if anyone reached out through adviceperiod.com or email me at larry.miles@adviceperiod.com. Would be happy to send you not just that white paper, but also the fee calculator that illustrates how the fees work.
I tell you, that's a very interesting model. And you guys also have services for financial advisors. Is that correct?
Yes, we've set our business up to be a franchise-like model for financial advisors who are looking to plug their business into a national network of like-minded planning-first advisors. We started this business about 18 months ago, and we have about 20 financial advisors across the country, from Atlanta, Georgia, to Rhode Island, to the state of Washington, to several offices in California and Texas and Ohio. So it's been a rapidly growing business for us, and it's fun to see that there's so many like-minded advisors across the country.
And how could listeners find out more about that opportunity?
Adviceperiod.com. Email me, follow us at @adviceperiod on Twitter, and all the information's there on the website. And obviously, we'd be happy to send you any more of it. Anyone who's interested. And all of this, to me, speaks to I don't think there's ever been a more exciting time to be in this financial advisory world. And from listening to all of your guests on the podcast to the technology changes, advisors have more tools than ever to help clients. And that's fortunate because I think clients need us, the financial advisor world, more than ever. And so this is just a really exciting time to be in this business.
I couldn't agree with you more, Larry. Thanks so much for coming on the podcast.
Jay, thank you for having me. Really, it was a pleasure. Thank you.